Hey folks, Dan Frio here with your market update for September 6th, 2024. So we just got it. We just got the unemployment numbers. So I'm going to take it right over to CNBC so they can give you the news. And then when we come back, I'm going to show you everything that's happening behind the scenes. So take it away, CNBC, with the daily numbers.
And Steve Leisman, what number are you going to start with? What number are you going to start with, Steve?
I don't have the number just yet, but we're looking for 161,000. It should be coming across any second now. Let me check the BL. There it is. 142,000 versus July, which revised down to from 289,000 from 114,000. June, big revision to 118 from 179. I cannot do the math. Somebody do 11 and 14 for me. That's 25,000 for the July revision, and it looks like 61,000. So what's 25 and 61 is 87 or 86, is that right? So big revision down for the prior 2 months. I'm looking at the unemployment rate. It did tick down to 4.2% from 4.3, right in line with
Okay, here's what I don't get. They just revised the numbers down an additional like 90,000, okay? And he'll continue with this. And then I still am complexed from last week when we lost 800,000 jobs, but the unemployment rate stays the same. Okay, guys, it does, work with the participation rate and everything else, but you just saw almost 900,000 jobs just disappear, and the unemployment rate stayed the same. Interesting, but I'm going to go. We'll continue with this, but then I want to show you the revisions so far this year. It's absurd. So let's get over to it.
Let's see if I have any other headlines here that I can scare up. That's all I have right now. I'd have to go to the BLS report here, refresh my page. Rick has it scrolling across the top. I do not. I'm going to go quickly to the B1 table, and I'm going to tell you where the jobs were and where they weren't. Looking here, quickly, 142 over, all private sector, 118. So we're talking.
So what we want to focus in on is the real employment with the economy. What do we need as employment? Well, we need people in the servicing sector, as we know. We need people in manufacturing. We are losing the manufacturing base here in the United States. We're becoming just a service, basically a service-oriented country, but that's where we're losing right here. But I'll just go take a guess out here. I bet you the government added jobs. So let Steve continue. But these numbers are kind of, I'm completely at odds right now.
Talking about some 20,000 or so, 24,000 jobs were from the government sector. It looks like there was positive gains in negative on manufacturing, minus 24,000. Scrolling down, I'm going to try to find the two areas that have been really private service providing 108,000. Retail trade minus 11. A lot of negatives I'm coming across here.
The yields are going down a little, Steve.
Transport. Yeah, this is a relatively weak number. It is an improvement, but you put those together with the revisions, which shaved off. What did I come up with? Almost 86,000 jobs.
Yeah, and it was bad to start with, wasn't it?
It was. Well, no, some of them were high. Like one of them came way down. It was a 179, came down to like 118 or something like that. I want to just check leisure and hospitality, which has been a place, obviously, where we've had a lot of gains, and private education, health services, a big part of it, 47,000. Healthcare within that, up 44,000.
No hot inflation numbers anywhere, are there?
Well, the average hourly, I'll tell you.
What do you got, Beck?
Up 0.4% versus the up 0.3%.
That's pretty strong.
And average hourly year over year, up 3.83% versus the up 3.7% that had been expected. So maybe a little stronger.
Yeah, so there's 46,000 on leisure and hospitality. And government, again, like I said, 24,000, of which almost all of it was in local government, 22,000.
Local government. Okay, so you heard Becky kind of come in and say, well, wages increased a little bit as well, but okay, they went up 3.7%, but our inflation rate was at 9%, and now it's at, say, 3%. Why do you get a raise every year? So you might say, well, because I'm doing a great job. No, the reason why you get a raise every year, it's usually 3 to 5%, is to keep your income equivalent to where it was, based on inflation. So if you have inflation at 3 or 4% a year, you have to get a raise. You have to get a raise at 3 or 4% a year just to keep the same purchasing power. So I'm at odds with a lot of this data that's coming in today, but we'll continue because we're only about halfway through. But let's see what else he has to say.
Of which that was X-education. So I'm seeing I don't know what the diffusion number is. I'm guessing it's down near 50 or 60% in terms of where the jobs. I'm seeing a bunch of negatives, a bunch of positives. look, in a normal world, this would be a good number because we've gotten so used to these big numbers near 200. Clearly, the job market's softened. Clearly, it's weakened. We have to take this number with a grain of salt because of the revisions I told you about in the 7 o'clock hour. That happens a lot. Plus the idea that you have these downward revisions. You have the ADP number led you, as I said before, people discounted. I think they're wrong. It led you in the right direction. And I'm just going to very quickly check what's happened to the Fed funds probabilities here because we were on the cusp of a 50 for September.
Not enough for anything.
It's going to refresh. It's going to move. Yes, now we're just barely 51.49 on a 50 now.
Okay.
We flipped from 57. Now, what happens, Joe, this is very interesting, this has been happening the whole time, is now the probability of a 50 in November becomes a probability of a 25.
Just because it's going to add up to 100.
The market is darn set on 100 between now and the end of December, and it just shifts around how it gets there, but it's really at 100, maybe a little bit more now. Now you've got a 68% probability of a 50 in December. So look, 100, 100 and a quarter, I guess, is now where we're talking about. So a little bit more easing. And I can do one other thing here, which is check what we're looking for a year from now and looking for 6 months from now. So if I look at the September 2025 Fed contract, I get a error rate. No, yeah, there it is. Okay, so 3%, right at 3% 1 year from now. So
I'm going to show you what he's looking at. So let's take a little bit of a dive into these numbers. Here's what the numbers were, but right over here, these are the revisions. This is crazy. Like January, the number was huge in January, so we'll take that out, okay? But it was 220. They missed it by 220,000, then 14,000, 12,000, 73,000, 29,000. 30. This is nuts. Okay, so maybe you guys should elect me down below to be the economist for the federal government when it comes to a lot of these numbers. So that's what we're seeing right here. Let's go through the main headlines that we're seeing so far. Average hour earnings, it was negative 0.1 previously. They thought it was going to be at 0.3. It came in at 0.4. We'll say that's coming in right in line. We need people to make kind of more money if you're staying on those jobs. Non-farm payrolls. Last reading, it was revised to 88 or 89,000 new jobs last time. This was a huge revision downwards. You can see that they expected 164,000. It came in at 142. This is going to get revised, and let's see where it gets revised. If it gets revised on the average, it's going to be it might lose 20 or 30,000 jobs. So that's going to increase the right through here. Here's what I don't understand. Again, our unemployment rate was 4.3. We had all these people not getting jobs. And then we also had, again, and I keep harping on this thing, where did those jobs go? And so the unemployment rate went down. I don't get it, folks. I don't get it. All right, so that's it. Let's see what the markets are doing right now. The Dow Jones is saying, okay, this number's not so bad. It's coming up 150. S&P's basically completely flat as a pancake. We had the S&P or the NASDAQ down 140. Oil is ticking up, but we're still under that $70 range. Let's see what cryptocurrency does. And it is, I will say flat. It's down $30, holding steady at 56. That's basically where I bought it this week. So that's that part of it. Let's get to the CME FedWatch tool. Now, here's the huge revision. Here's what he was talking about. So again, what you're seeing across the top, these are what the federal funds rates can be. This is the projection. So right through here, these numbers, this number would be like 2.75, 3, 3.25, 3.5, over to here to 5. Right now, the federal funds rate is 5.25 to 5.5. It'd be this cell right through here. Okay, they're expecting the Fed to cut a quarter right through here. So here's the disconnect. Now they're saying at the November, we're going to be down to 4.5. Okay, we're at 5.25 to 5.5 now, so that's a pretty substantial change. But here's what Steve Leisman was saying. He said a year from now, the contract a year from now would put us over here. There's a 61% chance that the federal funds rate would be 3. Right now it's 5.25, so that means 225 basis points, 2.25%. The Federal Reserve has the room to cut. That's what they're saying through here. So there are cuts coming. It's just like Steve Leisman was saying, how are we going to get there? And as they cut, mortgage rates will be coming down, but they don't go in tandem with this. So that's why you got to watch our videos every day. Join us on our Wednesday live events so you can learn how all this works when it comes to the financial markets and housing. So let's get over to the MBS market. When the market opened today, based on this numbers, it shot up to here. It was up like 40 points, and now it's giving them all back. Now we're in negative territory. So the markets are digesting this data. I don't know what they're going to do with it. It'll eventually kind of smooth out. But the numbers, to me, I'm going to look at the employment numbers. They're not enough. It's not enough right now for the Federal Reserve to cut a half a percent. I don't think it is. But as these numbers get revised down and down and down, will that put us there? Yeah, maybe. But again, we're not having job losses. We don't have a net negative when it comes to jobs. So that's a good omen there. So that's what we're seeing so far today, this morning, with the overall markets. So mortgage rates are going to be basically steady right through here. I thought we were going to maybe hit, when the market opened up this morning, up 40. I thought maybe we'd hit in the 5% range. We'll get there, folks. We'll get there gradually. You can see the Govy loans right through here. The FHA and VA loans, they are in the 5s right now. So we're going to see how all the rest of these manage. So what these rates are right here, these are not my rates. These aren't any individual bank's rates. What happens is Mortgage News Daily survey lenders all over the country. They have some 5 questions. And these 5 questions are very important, especially if you're new to watching this channel, because you probably go through a lot of websites checking out to see what rates are, and they're all different. Okay, how they do this is, most of the people are going to post rates up here that they're favorable. They look good. Okay, what do these rates consist of? Because you're like, okay, Dan, do I qualify for these rates? Because when I called in somebody, they said my rate was 6.5 or 6.75 or whatever. Why can't I get those rates? Well, here, let me give you the backdrop of what these rates consist of. The rates over here consist of a person buying their first house. It's going to be a single family home, and it's going to be their primary home where they're going to live. But they have 2 other criteria behind them, and they're pretty darn good. Right through here, this means these people are putting down 25% of a down payment, and they have a 780 credit score. If that's you, well, that's probably most likely what your rate's going to be. If that's not you, here's what I need you to do. Go over to the rate update. Why? It's my website. Okay, my name is Dan Frio. I do this report actually twice a day, the opening bell and the closing bell, let you guys know what's going on in the equity markets as well as the bond markets and everything else. But I'm a mortgage loan officer. Okay, the good news is I'm licensed in all 50 states as well as Puerto Rico, so I can help you no matter where in the country you are. So take my 35 years of experience, put it to use for you and your family at this time, because it's uncertain times. But we do have a grant finder. If you're looking to buy that first house, check it out. I just did a video the other day as well. I'll put that right up through here. But check out the grant finder, and it gives you a couple different things here. If you're looking for a grant nationally, click the national grant finder. If you live in Chicago or the Chicago suburbs or collar basically counties, check out the Chicago grant finder. It gives you grants up to $10,000 if you're looking to buy your first house. But if you're trying to buy maybe your first investment property, maybe looking to refinance, debt consolidation, or even a reverse mortgage, click the apply now button. You'll be on your way. Or you can actually scroll down to the bottom of the website right through here, and you're going to find our 800 number as well as my email address, and it is right through there. Our 800 number is 844-775-5626. And guys, there's only one of three people that's going to be answering. It's going to be me, David, or Alan. So don't worry about calling a call center, and we all have over 20 years of experience in this business. But if you'd rather just email me personally or directly, you can use my email right through there. So thanks so much for watching, guys, this morning. The markets didn't do kind of what I thought they were going to do. The jobs numbers did come in a little bit lower than expected, but the markets are just completely flat at this time. So check out later this afternoon. I'll let you know where the markets ended. Take care. Have a great day. Bye-bye.